this class, the Forex market size and liquidity. The Forex market, it is how big the market it is and liquidity of it, how liquid and flexible it is. Now, we start to talk about the sectorized breakdown, the interbanks market. Now, here we are going to see how the Forex market, they operate through the internal banks or the multiple banks. This is from one bank to other. And there is no a certain building that consists of the operation of those different banks. You understand now? We see how it connects with different parts all over the world, but it doesn't have a single building that we say it is a bank built for connection of or for trading Forex or exchange of. We start by a recording where we talked about the exchange of goods and services. Maybe that is the exchange of goods or the currencies from one place to another. Now here we see how we operate the Forex market and how flexible it is. Now, the flexibility of the Forex market and liquidity. Now you see, we don't have a certain bank or a certain building formed to connect to other banks in other parts of the world. Now, we see it is we start with the over-the-counter. The Forex market doesn't have a physical building of connection. It connects through an internet connection. That is a global internet connection. How? Now you see, one country to connect with another, like the Japan and the United States. Now, if there is internet connection for the traders, they will connect perfect because they will connect through internet connection. As long as there is internet connection, they will connect well, and the trade will progress in a certain way that will be flexible to everyone. This is how I mean. Location of a central exchange like the New York Stock Exchange. The New York Stock Exchange, it has a building in New York Stock Exchange, and it is the largest stock exchange in USA. Now, Forex flexibility and liquidity, it is not like that. It is from one country to another, but with connections. This is via how can I trade dollars while I'm in Japan? How can I trade Japanese yen when in USA? That is in US dollars. Now this is how we're going to look at how do you trade with different connection. No, we don't have a bank at we buy US dollars from the Japanese yen, that we have a bank here. That is the connection of the banks. The money comes from this part. No, it doesn't work like that. It is a connection of different global connection for Forex traders. That is why it is called a Forex market and liquidity. Liquidity is how flexible it is. It can be traded all over the world. Now here we see global access, because it is an electronic network. Trading can occur anywhere in the world as long as it has an internet connection. If it has an internet connection, it can connect all over the world, starting from Japan to Australia to anywhere. You can, whenever you have an access to internet, you cannot connect. You can connect Forex trading, and you cannot connect anywhere global of the world, from USA to New York, from Japan to Australia, from Canada to, you can trade Forex it is a global. As long as you have internet connection, it is more flexible. It doesn't have an internal bank, a specific place. You say it is built for, like the way you go to bank, exchange US dollars, you exchange Japanese yen. No, Forex market, it is wide and it is flexible for everyone accessing the internet. Now, let us look at the next chapter that we're going to look at. We see what is being talked about and the currency anarchy. In this, you see this chart, the USD dollars, the USD, it has high amount of percentage compared to the others, and the euro follows with 39% of the how Forex market is big on wide on the economy of the country. Now, if you see at Japan follows as that with 19% of the flexibility and the liquidity of the market, and how Forex is traded through that countries. Now, the USD makes up roughly around 62%. What does that mean? 62%. This, it is how the political system of the country, it is big, how the economy of the country it is, though it beats all the countries that follows it. That is the Japan, okay, being the second one, it is beaten by the USD, the US country, because of the way the country it is, the growth of the country, it is high. That is the economy of the country, the political systems, and the military itself of the US. It is a bit high compared. Now, when it comes to Forex also, when you trade this Forex, the trading of currencies, it is high. Ask me why. It is high because the growth of the country itself, we studied earlier about the growth of the country, it is a bit higher, more than the foreign countries. Now, if you see the exchange reserve, the foreign asset, also the central banks of the USA, or the banks of containing the currencies of the donors, they contain high amount of flexibility of the Forex liquidity. USA will always win, will always top in terms of the currency exchange and the Forex trading market. Get the point? Why is the USD is the king? USD is the king. Dollar dominates because of the US features what the largest economy, the most liquid financial market. It is the most traded financial market. That is the USD currency. It is the most flexible in all global. The dollar is the king because consisting of 62% of the flexibility in terms of economy, military, the central banks themselves, the growth of the country, it has high demand. It is okay. People like it because it is more flexible. You can access anytime you want. The US it has a high volume of the trading and of the in terms of the Forex market, it is a bit high, and the liquidity it is very high. Yeah. Now let us look at the second chapter about this. What we're going to check how the commodities are being traded. How the commodities are being traded in border as a trade. That is between, let's say an example of the commodity like oil. Oil from Saudi Arabia, it is a commodity that is a very high used commodity, transformed to, let's say it is transported to Japan. It is also transported to all over the country because it is the best in in oil production. Now, this commodity of oil from Saudi Arabia, for it to be transformed to Japan. So the Japan market, they will have to swap their yens to USA. Now you get? For every commodity in this, for every commodity purchased from Saudi Arabia, it should be in currency of US dollars. Why? Because they keep that as an asset to their central banks for their foreign, let's say for foreign asset, yes. Now, the Japan, they have to swipe they have to swipe their yens to USD so that they can give the USD dollars to Saudi Arabia so that they can purchase from Saudi Arabia. When they purchase from Saudi Arabia, this commodity is being transported to Japan. Now, that is where the value is for the commodities like oil. Transporting from Saudi Arabia, you have to swap your yens to USD. That is why US dollars, it is the most traded and the most popular, the most flexible currency all over the global, all over the world. No, the people, it's just, you see, this US dollars, it has the most, okay, even the people all over, the growth of the central banks, they have the foreign exchange, the revenues, they are a bit high because of US dollars. And it is the very high currency consumed by people. That is why it is flexible. Now, the serves as the primary medium of exchange of global cross-the-border commerce. It serves as the border of the commerce. This is how you can't purchase oil from Saudi Arabia using maybe Japanese yen. No, you will have to swipe to US dollars. So it serves as a center of the commerce. Now, also, it is a major commodity. Like, it is strictly priced as a dollar in country. In every country, for you to purchase a commodity like oil, it is purchased under the US currency, under the USD currency. Global banking guys, the asset owed and are massive for the foreign asset. This is Bank graph 16.7 domination strictly in US dollars. In NOS providing the heavy reliance on steady dollars. Now, these companies and the central banks, they own that revenue because the USD is the most currency and the most moving. It is most popular, its value is very high. That is why the central banks prefer these commodities because they are most purchased all over the world. They should be in dollar to keep the value and to keep the asset in the central banks for the future reference for the commodities. Yeah. Now, this fourth chapter, speculations and the market liquidity. Now here you see the waves of the water and the real shape. This is the boat. This is the waves. Now, primary functions. Forex exists to transfer funds. Forex exists to transfer funds between currencies, provide short-term trade, credit edge against price fluctuation and allow speculations. Now, more than 90% of all Forex traders, for trading volume comes from speculation of buying and selling of the asset purely for short-term persuasions and short-term profit. High market liquidity because the volume of the buying and selling is so enormous. the market has incredibly high liquidity. This means traders can buy or sell massive quantities of foreign currency with minimal impact on its price. However, this depth can still shift based on the specific currencies, pair, and time of the day. Now, the volume of buying and selling is so high and incredible for the liquidity. This is how the specific currency pair, time of the day, can still shift based. And this is how the minimal impact it is for the price. You get? Now, next lesson we discuss more about how to trade Forex. Now, for these ones, we had here both the speculation and the market liquidity. This is our last chapter. But the next topic, we're going to study how to trade Forex. Okay? Now, I end my class there. Thank you for your time and have a nice time here.